Hello, everyone, and welcome. I hope all of you are doing very well. Today, we are going to be learning about risk return and the capital asset pricing model. Now, right in the beginning of this course, I mentioned that one of the key things that we are supposed to learn in this class is how to do valuation. And we discussed that we will learn how to find free cash flows, which we have learned how to do. We will learn how to discount those free cash flows. And we also at that time I mentioned that we are going to be discounting the free cash flows on something known as WACC, the weighted average cost of capital. Now, in today's class, we are going to be learning a lot about the capital asset pricing model, also known as CAPM. And the reason that this is very important is that the CAPM actually influences WACC, or the weighted average cost of capital. So one of the things that we do need to know is how to calculate the weighted average cost of capital. But even before we learn how to do that, we need to understand the model of CAPM, just because they are very, very closely interrelated. So without further ado, after this introduction, I'm now going to start talking to you about, risk and return. So I want to start off by talking about return, and then I'll eventually get into risk. But the first thing that we really need to know is that the rate of return is something that you many times hear of, and you also hear of the actual return that is earned. So return can be expressed in dollar terms or percentage terms. When we talk about the rate of return, we are talking about expressing return in a percentage term. And how do we calculate the rate of return? Well, the formula is right here. The amount received minus the amount invested divided by the amount invested, and that gives you the rate of return. If, however, somebody asks you, what was the dollar return? What was the absolute return? Then you just basically, all you need to do in order to calculate that is take the amount received and you subtract the amount invested, and that will give you the actual dollar return. So that's just a little bit about, investment returns. One thing that's very important to mention right in the beginning is that the amount of return that is received by anybody is usually in proportion to the amount of risk that somebody is willing to take. So the higher the risk, the higher the return. And I think, you can imagine that there's, let's say, a very highly competitive exam that somebody takes. Well, in that case, there is a very high risk of failure, right? Because it's a very competitive exam. But at the same time, if somebody is able to pass that highly competitive exam, then there will be a lot of return for that, right? And they will be very highly appreciated, and maybe they'll get a very good job. So this is an example of risk and return. So the higher the risk, the higher the return. And also, since we are talking about the weighted average cost of capital, it's also important to remember at this point that higher risk will lead to a higher weighted average cost of capital as well. All right, now that I've spoken to you about the investment returns, I'm now going to start talking to you about risk. Now, there are two, so before I go into the types of risks, the first thing I want to talk about is what is risk? And risk is the chance that an unfavorable event will occur. So, right, like I just mentioned in the example of taking a highly competitive exam. Well, if it's highly competitive, meaning that it's a very difficult exam, then there's a high risk I mentioned of failure. And that is, there is a lot of risk because there is a high chance of an unfavorable event, meaning a failure occurring. So that is basically what risk is, the chance of an unfavorable event occurring. Next, I want to talk to you about, how assets can be sort of analyzed. And so assets, whenever you're looking at assets, you can either analyze them on a standalone basis or on a portfolio basis. So let's talk about the difference between a standalone and a portfolio. So just imagine that you maybe just have one asset. So there's a family and they only have one asset. That one asset may be their house, okay? And everything else, let's say they don't own anything else. That's just the one asset they have. Now, obviously, because they only have one asset, they are going to be considering anything that can happen to that one asset. On the other hand, if there is a family that has a number of assets, they have a car, they have a house, they have, let's say, a bank balance, they have, a number of different things. Then when somebody is going to be talking about risk or, their assets, they're going to be looking at it more on a portfolio basis because there's more than one asset. So when you're only looking at one asset, that is basically you're assessing assets on a standalone basis. And when there are many different assets, a number of different assets, a group of assets is called a portfolio. So you can either assess assets on a standalone basis or on a portfolio basis. It really depends on the situation. Now, again, standalone risk is going to be risk if an investor only has one asset. So let's say somebody is just holding on to one asset and all of a sudden there's a fluctuation in housing prices. So maybe all of a sudden all the housing prices in the market go downwards, then that's a big risk, right? But on the other hand, if somebody has many different assets, even if the housing prices go down, maybe the price of the cars is going up, or maybe the interest rate that they're going to be earning in the bank is going up. So therefore they're not just so impacted by that one event happening, right? So standalone risk again is the risk that an investor would take if he or she held only one asset. One thing that is extremely important is to mention that no investment should be undertaken unless the expected rate of return is high enough to compensate the investor for the perceived risk of the investment. So let's say in the example I just gave, there's a really difficult exam, and let's say you are ready to take that exam and you're ready to invest, let's say 500 hours studying. Well, that's 500 hours. You could be doing something else in those 500 hours, but you will be willing to give those 500 hours if, for example, you are assured that you will end up with a fantastic job after you pass that exam. Similarly, sometimes people are ready to become a doctor, or they want to become an engineer or an MBA. Well, that's a rather large investment of time, right? It takes several years. If you're doing your BBA, it takes about 4 years to do your BBA. The only reason anybody should be willing to do that is if the expected return is high enough to compensate for the investment, right? So you want to make sure that you're ready to do it, you're ready to make the investment, pay the fees for 4 years, because at the end the expectation is that you will be compensated and that you will earn salaries that are a lot more than the investment that was originally made. Now, would it make sense to really study that hard and make that investment of fees and energy and time if you weren't going to be making a return on your investment? Absolutely no, it would not make sense. So again, no investment should be undertaken unless the expected rate of return is high enough to compensate the investor for the perceived risk of the investment. And again, the risk of the investment is that, let's say somebody you invest something and you don't get any return. So so the risk is income, has to equal the return at least. All right, talking a little bit more about standalone risk. um, Investment risk is a probability um, of actually earning a low or negative return. Okay. Now, investment risk, again, this is important. It's the probability of actually earning a low or negative return. So let's say, God forbid, somebody studies for 4 years and they are not able to get a good job. Well, that's an investment risk. And generally speaking, people do take sometimes calculated risks, but obviously people don't want this situation to happen. So but it's important to realize that there is something called investment risk. The greater the chance of a low or negative return, the riskier the investment. So let's say, people, for example, end up paying a huge amount of fees and they study a great deal to get into Harvard. Again, why Harvard? Why any one of the Ivy Leagues in the world? Why do people want it so badly? Again, because there is a low investment risk in those. If you are able to get the admission and go to such a university, the probability of you getting a very good job is very high, and the investment risk or a risk of a negative event happening is very, very low. That is something to keep in mind. All right, next I want to talk to you a little bit about probability distributions. Now, what is probability? Probability is that in the chance that an event will occur. So again, if you, let's say, toss a coin up and you try and figure out whether it will be heads or tails, well, there's a 50% possibility that it will be heads and a 50% probability that it will be tails. There are only two options, and therefore there's a 50-50% chance. So again, in this situation, if somebody says, what's the probability of a heads occurring? Well, it is the chance that an event will occur, that if you flip the coin, that heads is going to come, is 50%. Now, if we map out all the possible events or outcomes and we list them and we assign a probability to every single event, then we will have a probability distribution. So again, probability distribution is when you list all the possible events or outcomes and you assign a probability against each of the outcomes. Next, I'm going to talk to you about the expected rate of return. Now, if we, in the last situation, I kind of gave you a situation of what a probability is, like every single possible event happening and assigning a probability to it. Now, if we have to calculate the expected rate of return, what we have to do is we have to multiply each possible outcome by probability of the occurrence and add the values. This gives us the weighted average of outcomes, also known as the expected rate of return. So let's see if there's an example. Okay. No, well, let me just give you, I think I've already shown you an example of this in the class, but let's say there is a situation where there's a, probability of, that the return is going to be 1%. Let's say there's a, 10% probability of that. The probability that the return is going to be 2, maybe there's an 80% probability of that. And the probability that the return is going to be 3, maybe there's a 10% probability, because remember, your probabilities have to add up. Well, if you have to find the expected rate of return, you would multiply the probability with the returns in each of the case and add them all up. And so basically all you're doing is taking a weighted average. And when you take the weighted average, you will get the expected rate of return. One thing, and I've already discussed this in great detail in the class with you in the last class, but I'm also going to discuss with you again over here, is that the tighter or more peaked the probability distribution is, the more likely that the actual outcome will be close to the expected value and won't end up far below the expected return. And I'll explain this to you in just a second. Therefore, the tighter the distribution, the lower the assigned risk to a stock. So just imagine these are two situations. There's one situation, let's say, just for the sake of an example, let's say these are grades. Okay, let's say that this is the grades in one class and these are the grades in the other class. And somebody asks you, which class would you rather be in? Well, in one class, you'll notice that there are, there's a wider distribution, and in one class, it's a more narrower distribution. So probably like in this class, if you're in the bottom class, what's going to happen is there are going to be a lot more people that have A's maybe, but there are going to be a lot more people that also have D's and F's, right? C's, D's, and F's. Whereas over here in the first situation, you have a tighter probability. There's probably a lot more people that have B's, and maybe nobody has an F or nobody has a D. And yes, there may be less A's, but at the same time, the risk of having a very negative outcome is much lower. So therefore, the tighter to measure the tighter the distribution, the better. And how do you measure how tight a distribution is? Well, the way to measure it is by taking the standard deviation. And now the big question is, well, how do you calculate the standard deviation? And this is, the formula right over here for standard deviation. Just to break it down for you, I will explain it in some steps as well before. So here's the formula, but all I'm doing is I'm going to explain this, how you would sort of plug things in and calculate this. So the first thing you need to do is calculate the expected rate of return. And we just discussed this. This is going to be basically the probability distribution. You multiply the probability in the probability distribution with the expected rate of return for each of the probability distributions, and you take a weighted average. So you do that. And then next, what you have to do is you have to take, each of the returns and subtract it from the average return. And then you sort of, this is a summation sign. So it's, you add a plus over here, and then you add yet another one. And if you guys need, a live example, we can discuss this in class, and I can give you a live example of this as well. But, in this class, I do allow you to either use either you can use Excel, or you can actually sort of write things out. So if you want to use Excel, you can use the standard deviation formula, and you can easily calculate it. And actually, I will give you a live example in class if you would like, but I'm also going to go through an example on the next slide with you of how to calculate the standard deviation. So over here, we have, the rates of returns over 3 years. So in 2014, the rate of return was 15%. 2015, the rate of return was -5%. In 2016, the rate of return was 20%. So the first thing, and since, there's no probability distribution given over here, we assume that it's an equal amount of probability of each of these, and so it's 33.3%. So long story short, it's equal distribution. You can just average these out. And so if you take the average is 10%. And then when you're calculating the standard deviation, which is, you have to take every return and subtract it from the expected rate of return. So since the expected rate of return is 10%, all you have to do is take 15% minus 10%, and you square it, plus -5%, which is right from here, minus 10%, you square it, plus 20% minus 10%, you square it. And right at the denominator, you have to take t minus 1, and t is the number of occurrences. So it's 3 years. So it's 3 minus 1. And then you take the square root of all of this, and that gives you 13.2%. Now, as I just mentioned in the previous slide, a shortcut to doing all of this is you do need to know how to do it, but if you're running short on time and you have a question of calculating standard deviation on your exam, I would highly recommend using the Excel function, which is STDEV brackets, and all you have to do is convert these returns into decimal places. So it would be 0.15, negative 0.05, 0.2, close the bracket, press enter, and you would get 13.2%. So that's just a little bit about measuring risk. Now, if you wanted to measure, you wanted to compare, several different products. Let's say you had a certain amount of money and you can only buy one particular product, and you wanted to see which one you would like to buy. Well, looking at just the standard deviation won't give you the answer, but if you calculate the coefficient of variation, you can easily compare alternatives. So coefficient of variation shows the risk per unit of return and provides a more meaningful basis for comparison when returns on two alternatives are not the same. So again, if you're comparing, you want to invest in some, only one asset, and let's say there are two options. Well, if you look at the coefficient of variation, and you choose the one with the lowest coefficient of variation, you would be in a good situation. So because coefficient of variation captures effects of risk and return, it's better to measure than just standard deviation for evaluating standard-owned risk in situations where two or more investments have substantially different expected returns. So again, as I just mentioned, coefficient of variation is very good when you're comparing, standalone assets, and you want to make a decision about which one you would like to really invest in. Okay, one thing to sort of mention to you is that most investors are risk averse. Nobody likes a negative event happening. If you are a student, obviously, and you're investing a lot of time in studying, nobody wants to get a bad grade. Nobody wants to get it, fail. Those are situations that nobody really wants. Another thing to sort of, a new thing that I'm going to be introducing over here, it's introduced in this chapter, is the risk premium. And the risk premium is basically the additional compensation investors want for assuming additional risk. Markets will force this to occur. So if you have to take on, additional risk, well, then you would want additional compensation for it, right? So if, for example, you're having to, and I just gave that example at the beginning of the class as well, but let's say you're sitting in for a very, very difficult exam, well, then you really want to make sure that it, you definitely will end up with a fantastic job once you go through that very rigorous studying and pass the exam. And you won't be ready to sort of take that exam unless you are kind of guaranteed, or you are, you're very sure that you will be compensated, right? So the risk premium is the additional compensation that investors require for assuming additional risk. Okay. So that's something. So just think about it this way. Obviously, you would be willing to study extra, do more if the return is higher. Otherwise, you'll say, no, not worth it. And you would say, you would maybe choose not to do that particular difficult course. All right. Next, I'm going to talk to you about risk in a portfolio context. So until now, we were talking about standalone risk. The risk if you just own one particular asset. But if you want to calculate the risk of a portfolio, right, then as this is a little bit different. First thing to mention is if you are holding an asset in isolation, it is more risky than if you're holding an asset in a portfolio. And just a couple of slides ago, I gave an example of a situation where there's a family that only has, one asset, maybe they only own a house, and that's very risky because anything can go wrong in the housing market and they could be, in a bad situation. But if they own several assets, then it's less risky. What's important is the return and risk of the portfolio. Risk and return of securities should be analyzed in terms of how the portfolio is expected. So when you have a group of assets, which is also known as the portfolio, obviously then in that case, you will be looking at the risk and return of the entire portfolio. So maybe you want to see, okay, what's happening in the market? Okay, fine. And how is this impacting my entire portfolio, right? Versus if you just have one asset, then you would be looking at, okay, how is this impacting that one asset? And that's always, if you only have one asset, that's always a more riskier situation. So when we are going to be calculating the expected return of a portfolio, it is calculated as follows. Basically W over here, this is the stands for the fraction of the total portfolio invested in an asset. So let's say that, maybe 10% of your assets are invested in product one, and that gives you a return of a certain amount, and that X amount of your money that is invested in the asset, that is the weightage over here. And, again, when you're plugging things into this kind of a formula, everything is going to be in decimal points. So please remember that. And if you want to calculate the return of a portfolio, basically all you have to do is take the weighted average and to calculate the expected return of the portfolio. Okay, so one thing to mention is, let's say you you have invested in the stock market. Now, if you are only holding on to one stock, that's going to be a lot more risky. But if on the other hand, you're holding a portfolio of stocks, that's not going to be as risky, because a portfolio of stock means you're holding a number of different stocks. So even if there is some sort of a shift in the price of one stock, maybe the company is not doing well or something like that. If you're holding a portfolio, that's okay, because maybe you're holding a group of assets. So maybe if the price of one stock is going down, maybe the price of another stock in your portfolio is going up. So it sort of works out fine that way. Another term that is introduced in this chapter is the correlation coefficient. And this is the tendency of two variables to move together. So whenever that happens, let's say there are two stocks in your portfolio and you kind of want to see, okay, do the price of both of these stocks always increase kind of at the same time and decrease at the same time? Well, you can figure that out by calculating the correlation coefficient. There's a rather, long and a little bit complicated formula for calculating it, which is given over here. But it's important for you to understand exactly what the correlation coefficient is. Also, if you have a positive correlation, that means that stocks are moving up and down together. If on the other hand, you have a negative correlation, that means that all the risk is, being diversified away, and that if one stock is going up, then then the other stock is going down. So that's what a negative correlation indicates. Usually the stocks have a correlation of about 0.3%. When you combine stocks in a portfolio, it doesn't necessarily completely eliminate the risk. So even though, let's say you have a big group of stocks and you say, I'm going to take a lot of different stocks and put them in a portfolio, again, there is still going to be some sort of a risk, because, even though you have a portfolio and it's less risky than having than a standalone asset, still there is going to be some level of risk. It is impossible to form a riskless stock portfolio. A situation where there's absolutely no risk, that just does not happen. Diversification can reduce the risk, but it does not eliminate it. And there is a rule, and the rule is that if the risk of a portfolio goes, the rule is that the risk of a portfolio goes down as the number of stocks in the portfolio goes up. So the more stocks that you have in your portfolio, the lower the risk. In general, there are higher correlation between returns in the same industry than in different industries. So therefore, it's good to sort of, if you want to minimize risks, it's good to diversify across industries. So obviously, if you buy everything, like all the stocks in your portfolio are steel industry, I'm just giving an example, steel industry stocks, and there's some negative event that happens in the steel industry, then your portfolio returns are going to go down drastically. Compared to that, if you end up getting, portfolio from different industries, maybe you go one from steel, one from FMCGs, one from fertilizers, a whole lot of different industries, then that will reduce your overall risk. Okay, next I'm going to talk about diversifiable risk versus market risk. Now, one thing to mention is that most stocks tend to do well when the economy is doing well. So when the economy is doing well, generally speaking, there are a lot of people buying goods, there's good sentiment in the market. And because of that, generally speaking, companies are doing well and stocks tend to, the stock market tends to do better. Prices of stocks increase. Now, a new term that is also introduced in the chapter is called market portfolio. And a market portfolio is basically if you make a portfolio of all the stocks in the stock market, that is a market portfolio. And if you do that, then generally the standard deviation of such a market portfolio will be 20%. And the standard deviation of one stock portfolio is 35%. So again, you can see that if you have a portfolio of a lot of different stocks, the standard deviation is going to go down. Almost half of risk inherent in average individual stocks can be eliminated if stock is held in a reasonably well-diversified portfolio, which consists of 40 or more stocks from a number of different industries. So again and again in the chapter, we learn that if you hold a whole lot of stocks, then the risk, basically the risk of that portfolio is going to go down. The more number of stocks that you hold, and as I just mentioned a little while ago, the more stocks you hold from different industries, the lower the risk of the portfolio. A part of the risk that can be eliminated is called the diversifiable risk. So let's say you're looking at the stock market, the part of risk that you can eliminate by, let's say, having a good portfolio of stocks is the diversifiable risk. And the part of stock risk, let's say, that cannot be eliminated in a portfolio is called market risk. So this is important for you to know that there are two types of risk: the diversifiable risk that can be eliminated and the market risk that cannot be eliminated. Now, diversifiable risk is events that are happening in a company and that affects stock price, right? So these could be random events, like let's say there's a lawsuit that happens, maybe a company is sued, or there's a strike, or they lose contracts or they win contracts, something that is happening to one company, right? But as I mentioned, it's diversifiable risk, because let's say you have 5 companies in your stock portfolio. Well, if there's something negative that's happening in one of the stocks in your portfolio, there's a high probability that the other stocks may be doing fine. So therefore, that bad negative risk that is happening in one company can be diversified away because it'll be offset by the good things happening, the increase in the stock price, let's say, of the other stocks in the portfolio. On the other hand, factors that systematically affect almost all firms, that is known as the market risk. And examples of this risk that cannot be diversified away include war, inflation, recession, high interest rates. So this is risk that just, even if you have the best portfolio, you just cannot eliminate this risk. Okay, next I'm going to talk to you about Capm, also known as the Capital Asset Pricing Model. Now, this is a tool that measures the relationship between risk and return. As you've seen so far in this chapter, we have spoken about risk and we've spoken about return. We spoke about it for standalone assets. We also spoke about it for portfolio assets. So that's something that we discussed. But if we want to sort of see the relationship between risk and return, well, for that, we need to use Capm. Okay, the relevant risk of a stock, this is a new term again. Relevant risk of a stock is the contribution to the portfolio's risk. So let's say there are 5 different or 3 different stocks in your portfolio. Well, the amount that each of those 3 is contributing towards the risk, that is the relevant risk of that particular stock. On its own, a stock is risky, and in a portfolio, half of the risk, however, can be eliminated through diversification. Therefore, relevant risk in a portfolio is much smaller than standalone risk, right? So again, the relevant risk or the risk that's being contributed by any one particular stock is lower in a portfolio because again, a lot of the risk can be diversified. In a standalone situation, standalone risk cannot be diversified away because we're only talking about one asset. Different stocks, one thing to mention is that different stocks impact the portfolio differently and therefore have different relative risks. Risks that remain after diversification is known as the market risk. This is a repeat, and that's inherent in the market, and it can't be measured, and it can be measured by degree to which a stock moves up and down with the market. So there is something, there is a correlation between what is happening in the overall market and what is happening in one particular stock's case. And if you want to sort of see what the market risk is of a stock, well, all you need to see is how it moves in accordance to the market risk. All right. Next, we're going to talk a little bit about contribution to market risk. And the first thing we're going to be discussing here is something that is called beta. And beta coefficient is basically the relevant risk of an individual stock. So this is again the amount of risk that an individual stock is contributing in the portfolio. Okay, and the formula is given right over here for beta, and this over here right in the numerator is the standard deviation on the ith or x number of stock return, and at the bottom is the standard deviation of the market return, and this is multiplied by the stock correlation with the market. And so this is basically how you calculate beta. So again, what we're doing here, you do need to understand, what's going on, what the whole idea of beta coefficient is. Again, I'm repeating, it is the relevant risk that is being contributed by an individual stock in a portfolio. Next, is the covariance between stock and market, and that is given by this particular formula right over here. This is again the stock correlation with the market. This is the standard deviation of the I stock, and this is the standard deviation of the market. And again, what is the covariance between the stock and the market? Right here. This is the formula. And also, again, you can see over here, if you want to, the covariance and the beta, this is the relationship between them. Okay. So now we're going to talk a little bit more about stock betas. And I'm going to start off by talking about individual stock betas. Now, the average risk stock has a beta of 1. Okay, so any average stock is going to have a beta of 1. And if a stock has a beta of 1, what does that mean? It means that it is moving exactly according to the average market movement. So if the market is going up and a stock has a beta of 1, it means the stock is going to go up. And if the market goes down, then the stock is also going to go down. So that's what a beta of 1 indicates. Most stocks have a beta of, sorry. Now let's say, for example, so I just discussed a situation where the beta is 1. But what happens if a beta, there's a portfolio that has a beta of 0.5? Well, this means that the stocks in that portfolio are half as risky as the market. And what happens if a portfolio has a beta of 2? Well, this basically means that the stocks are twice as risky as the market. Most stocks in general have a beta of between 0.5 and 1.5, and the average beta of all stocks is 1. If a stock has a positive beta, we expect its returns to increase whenever the stock market rises. That makes sense because, a 1 we discussed, it goes up and down according to the market. All right, next we will need to, let's say, understand how to calculate the beta of a portfolio. Well, that's very easy. All you need to do is take the weighted average of individual securities betas. So again, you take the weighted average of each of the, various stocks betas, and that will give you the beta of the portfolio. Now, since a stock's beta measures its contribution to the risk of a portfolio, beta is the correct measure of a stock's risk. So again, you in this situation are kind of looking at the overall portfolio. And here you can see, each one of the different stocks that you have and each one of the individual stocks beta is making a contribution to the risk of the overall portfolio. And therefore, this is how you measure the portfolio risk. Okay, next on this slide, it's sort of a summary of everything we've covered so far in this chapter. And I'm going to kind of go through these key points because they are important. So the first thing is that a stock has, 2 types of risk components. The first one is market risk that cannot be diversified away. And we learned that there are certain things that are impacting market risk are risks that are impacting all the stocks in the entire market. And the second type of stock risk is diversifiable risk. And this risk can be, eliminated. Diversifiable risk can be eliminated by diversification, and most investors do this. So most investors choose to have a portfolio of accounts. Very few investors like to have standalone risk. Market risk is caused by general movement in the stock market. So yes, if there is, for example, let's say a huge negative event like a war or something like that, the stock market will go down and all the stocks are going to go down. And that is just market risk that cannot be diversified away. It's just general movements in the stock market. Another point that was discussed is that investors must be compensated for bearing risk. The higher the risk, the higher the return. And the risk compensation is required for risk that cannot be diversified away. So if there's risk that can be diversified away, that's fine. But risk that cannot be diversified away, well, investors want to be compensated for that. Market risk of a stock, the market risk of a stock is measured by its beta coefficient. And this basically shows, how volatile stocks are. So again, since diversifiable risk is risk that can be eliminated, the entire focus is on the market risk that cannot be eliminated. And that, to measure that, we calculate the beta coefficient. Beta of a portfolio, if you want to calculate, is the weighted average of individual securities betas. And beta is basically the most relevant measure of stock risk, because stocks beta coefficient determine how stocks affect risk of a diversified portfolio. Okay, so again, very important to sort of take into account the betas of all the various stocks that you have in your portfolio, because each of them are impacting the portfolio. A Capm is basically a model that represents expected values, and betas are calculated using past period data and assume relative volatility will be the same in the future. So again, when you're calculating beta, you're going to be looking at historical data, and you're going to be using that to calculate what you expect the future volatility will be. Beta is calculated by drawing a regression. Beta is calculated by drawing a regression line between the actual historical returns and the market portfolio returns. And next, I'm going to be talking to you about just this last point about, calculating betas. All right. So betas can be calculated. We kind of just discussed this. So we discussed this, that they can be calculated, by a formula using standard deviation. But another way to calculate betas are by drawing regression and doing regression analysis. And how is this done? Well, first you have to collect a lot of data, and you have to take the stock prices and convert them into rates of return. So you're going to take the stock prices and convert them into percentages, and you have to plot them. Okay, and you're going to plot them, and you're also going to plot market returns. Okay, and you're basically going to plot the stock returns to the market returns, and then you're going to add a trend line, and that is basically going to help you figure out what the beta is. Basically, this, you can also do this using Excel regression analysis, right? And so basically you run a regression according to what are the rates of returns and what's happening, what are the market returns. And again, what you're trying to sort of figure out when you're calculating beta is, what is the relationship with what's happening in the market and what the rates of returns are. And that you can do by, regression. And the regression is going to give you, sort of make a formula out of it for you. And so that is also how betas can be calculated. Okay, next I'm going to talk to you about the relationship between risk and rate of return. So beta measures a stock's relevant risk. And again, the relevant risk is the amount that the stock is contributing to the overall risk of the portfolio. Now we want to find, but let's say we want to learn for a given level of risk measured by beta, what is the rate of return that investors should require to bear the risk? So let's say you know the amount of risk that is there, that's going to be there, but you want to calculate how much return an investor should request or accept to take that level of risk. Well, how would you calculate that? So in order to do this, you will have to calculate the risk premium. And the risk premium right over here, risk premium, this is basically the required rate of return on a portfolio of all stocks minus the risk-free rate of return, right? So this is kind of the market risk premium, the additional risk, um, additional return over the risk-free rate, right? So this is the additional risk that somebody is ready to incur. Sorry, required. So this is the additional return that the somebody wants above the risk-free rate. All right. Another thing, I kind of want to, and just I want to give you, let you know that we are slowly and steadily moving towards the Capm model now. So the next thing I kind of wanted to point out over here is the risk premium for stocks. So the risk premium for stocks, the formula for this is right over here, which is beta multiplied by the risk premium. Okay. And so again, if you really want to break this down, it would be the beta brackets, return on the market minus the risk-free rate of return and close brackets. Another thing to mention is the required rate. The required rate of a return is the risk-free rate plus the premium for risk. Yes, so as I was just mentioning, the required rate on a stock is going to be the risk-free rate plus the risk premium for the stock. Now, we are now going to be coming, this is basically Capm, right? Capital asset pricing model. And this basically is showing the whole relationship between risk and return. So here we have, if you want to calculate the return, that is basically equal to the risk-free rate of return plus beta, which is again measurement of the risk, multiplied by the market risk premium. And if you break it out, this is what the formula looks like. And again, this is a relationship between the required rate of return and the risk. This is also known as the security market line, or SML. And here you can see an example of it. And the risk-free rate of return is right over here. And this is going to be, this B into RPM. This is basically what's going to give you the slope, right? And again, if there's a high risk premium, you see, 10% risk premium, you see it's a higher rate over here because people want a higher return. The average, if the premium is lower, you see that the point is lower over here and the low risk is over here. So here, if somebody is holding a high risk stock, then the risk premium is going to be higher. And so basically the return that they expect is also going to be higher. Just imagine, the numbers that are going to be put into this formula are obviously going to be higher because of a higher beta. High risk stock is going to have a higher beta, and therefore the rate of return is going to be higher. And for the low risk stocks, the beta is going to be lower, the risk premium is going to be lower, and therefore the return that they're expecting is going to be, that's also going to be lower. Okay. Next, I want to talk just a little bit about the impact of inflation, and the risk-free rate. Any risk-free rate is calculated by the nominal divided by quoted rate. So this is going to give you the real inflation-free rate of return. And so obviously the nominal versus the quoted, right? And so a risk-free rate is equal to the real inflation-free rate of return multiplied by the inflation premium, or the anticipated inflation. Next, I also want to talk to you about changes in risk aversion. The slope of a market security line shows to what extent investors are averse to risk, right? So again, we saw over here, the market risk premium, if they really are averse to risk, then the market risk premium is going to be really, really high. And so the slope is going to be high, right? So if there's a situation where, they're not very much averse to risk, well, the SML is going to have a lower, slope line, right? So that's sort of something to remember. Changes in stock beta coefficient. Companies can influence the market risk beta by changes in the composition of assets, use of debt, and external factors. These factors can also cause changes in the required rate of return. So absolutely, so far we've seen that beta is one of the most important things that we have noted, right? Between the whole idea between risk and return, the risk factor is being captured by beta. But it is important to mention that the type, whether you're using debt or equity, the composition of assets that a company has, this also does influence, it has these are also things that do kind of cause, changes in beta as well. So these are just things to remember, that beta is impacted by the composition of assets, meaning debt or equity and things like that a company has. And with that, we come to an end to this particular lecture. I hope you enjoyed it, and I look forward to answering your questions in our next class. Take care.